Well, g'day there, everybody. Thanks a lot for joining me in this Tuesday afternoon market recap. Quite an interesting day across the board for the US markets. It was the first day, I believe, in over roughly 110 days where the markets themselves closed down over 1%. We saw the markets once again fail around this upper level. We didn't come up and tag this resistance area. In fact, what it appears to be doing is setting up a secondary lower high, which is a little bit concerning. In yesterday's video, really the pre-market video for Tuesday, I floated the possibility and the chance that we are establishing some form of a leaning double top. And really what we were looking for once again was really a close and confirmation below that neckline. Now, as at the close on Tuesday being the 21st of March, I'm a little unsure, even myself, whether or not this most recent pullback is going to really gather momentum and hold Wednesday through Friday. Really what we're looking at the moment is the potential for the market once again to hold up around this neckline, even potentially rally back up and establish maybe even perhaps the third lower high before we get that definitive crack. If, however, we really hold below this 20 exponential moving average on the Dow Jones Industrial Average, the 50 EMA is going to act like a magnet. And again, in the past and in past market updates, I have referenced this. When we start to break down below the 10 and also the 20 exponential moving average, oftentimes the 50 will act as a magnet. And in many ways, this instance, it is no different whatsoever. So if we do see a continuation below the lows of Tuesday's candle, expect the market, or at least the Dow Jones Industrial Average, to come back down and tag at least 20,451. A lot of people, a lot of traders, a lot of active and also non-active market participants are a little bit surprised due to, of course, this volatility creeping into the market on Tuesday. They are a little bit gobsmacked, so to speak. But again, we are just going through some form of natural consolidation, or at least a sideways market move. We have seen some rather impressive gains across the board for this market. It has been more or less up, up, up. It has been rather parabolic and very strong in its nature. However, if you pay attention to these oscillators once again, you can see they are still strongly in reset mode. And as I have also pointed out to you, you need to pay attention to the moving average convergence divergence, otherwise known as the MACD. When we get this sell signal, or at least the bearish alignment of the MACD itself, and when we see the histogram start printing into negative territory, it is, of course, a major warning for people who are looking to jump into bullish trades. If we continue the discussion, once again, the ADX definitively turned down very early in the month of March. I tried to warn you about this, to pay attention to that signal when it does show up. Having said that, it did show up. And as you can see, we're again continuing to see this pullback. What is becoming a little bit concerning, also, just to update you on this, is the simple fact that the CCI, the Commodity Channel Index, in the lower half of my screen here, is starting to break below that positive 100 area. So this is really telling us that potentially we are towards the end of this intermediate trend. Now, again, on the macro picture, and this is the big macro trend of the overall market, it is still healthy, it is still constructive. It isn't until we start to break below that 200-day simple moving average, which is a long way away. It's coming in just above 19,000 on the Dow Jones Industrial Average. And before that, obviously, once we start cracking the 50, where we need to, of course, begin becoming a little bit more concerned about the structure, the technical structure of this market. If we see this market pull back and overshoot the 50, potentially see it bounce back up to what may potentially be that neckline, well, then we'll be looking at something more so on the intermediate time frame in terms of a material correction. What you can expect really moving forward is that you don't want to be jumping into the market. I wouldn't be encouraging, or at least I myself and personally, I'm not buying the dip on this most recent pullback. What I'll be looking for, again, is to see the market stabilize, most likely around that 50. I'll be looking very closely at the candlesticks around that rising 50-day exponential moving average, and potentially trying to find myself a little opportunity to begin nibbling on some contracts, so to speak, or some derivative option contracts to gain exposure to the overall market. What I'll be doing then is I'll be paying attention to these recent swing highs, which is still yet to, of course, confirm that material breakdown, and to pay attention as to whether or not they are going to hold as resistance. If in fact we do get above them, which again is still a possibility, however, I'm not really holding my breath, so to speak. I think this is going to be sort of a longer type of prolonged retracement and also sideways move. But if we do get above these peaks, and if we do nibble on some of these derivative contracts around the 50 just to see what happens, well, again, we'll still be looking at this market to really confirm across the board on the Dow, the S&P, and the NASDAQ to really start breaking above the early March highs. Now, I've pointed this out to you in previous videos. This is what we call Dow theory, and really best to sort of surmise this is to show you the NASDAQ, because The Nasdaq up and through to the open of trading on Tuesday was the only market which was really sort of hovering around those recent highs. Now that of course is between the Nasdaq, the Dow, and the S&P 500. And what we were talking about was that we wanted to see all three markets in agreement. So this is a really good learning opportunity for a lot of people who pay attention to these market videos. What you want to be doing up and around these recent highs when a market is overextended and somewhat exhausted is that you want to see the markets confirm one another. If you found yourself jumping into trades around these highs again, you've sort of missed the boat. The trades were a couple of months ago. And again, all of those gains more or less should have been locked in, and you should have been thinking about, or at least changing, I guess, your interpretation of the market. In many instances, really tightening stops to lock in as much profit as you possibly can, instead of course, jumping in and hoping and praying that this market is going to continue. As you can see, if I zoom in onto the detail for you, you can see the Nasdaq, just how many of, or at least in terms of days, consecutive days, just how much of the gains, or at least these recent highs, have been given back in the space of one trading session. To me, just looking at this visually, we've got 5 sessions here, we've got another 5 through to here, roughly another 5 here. It's almost 1 month's worth of trading activity has been negated, or at least given back during Tuesday's sell-off, which we saw today. You can see the volume again spiking, so this is outside of options expiration. And again, this candlestick itself is what we call a long day Morobozu candlestick. It isn't really showing up, or it is in many ways a similar type of candle on the Dow Jones Industrial Average. We've got a little gap up to begin the trading session. However, again, you can see the volume really starting to pick up on the sell side. If we change to the S&P 500, we never reclaimed above 2,400. We didn't really push above 2,390. We didn't get anywhere close, so really 2,380. You can see again down 29 points on the S&P 500. It looks as though we have closed below that hypothetical neckline. But again, when you're talking about trend continuations, or at least trading pullbacks, you really need to be thinking about the actual trend itself. Now, the trend at this particular point, more so on the macro and the intermediate time frame, is certainly bullish. Here we are on the minor level. Again, we still don't have true confirmation that we have changed that minor level of the trend. At best, or really the most constructive way of approaching this market is just to conclude at this particular juncture that the markets themselves are still going through that natural reset phase, which we've been calling for a number of weeks right now. So again, I'm not jumping into the water to be shorting this market. It is in many ways too aggressive. It's almost as aggressive as buying the dip over here a couple of weeks ago, where again we were waiting for the market itself to break above confirmation. So again, at this particular point, it's best really, if you are trading this market more so in a swing time frame. So if you're holding individual stocks or options contracts for a number of days through to a couple of weeks or a number of weeks, really up until about a month, it's really best not to be doing all that much at this particular point. We are seeing a lot of stocks break to the downside, which is rather interesting, given, of course, this massive parabolic move to the upside. It looks as though some trends on the intermediate level in our top 12 individual trade list are shifting, which is offering us the beginning of some potential trade opportunity in a different direction to what we have been capturing as the market has been moving higher and aggressively higher. But having said that, we are still more or less 50-50. We can, of course, just turn and rally from this level. That is rather, or the possibility and the chance, the likelihood of that is rather low at this particular point. Really what you can expect is either that pullback to continue down to that 50 exponential moving average. If that does happen, you have to be thinking about, one, is it a buy the dip opportunity? You need to, of course, start consulting with some of the candlesticks showing up in volume signals, coupled with a few other areas of technical analysis. But at the same time, you have to be cautious to the simple fact that if we do break down, it could be that simple neckline retest, which is going to usher in more so an intermediate pullback on the larger wave fractal of this overall market. So I hope that's helped, I guess, address some concerns that I've been receiving. Again, the market's down over 1%. The first time in over 110 days. This is rather unusual for the market, but again, it has been anticipated, it has been forecasted, and here we are. We'll have to keep a very close eye on this to see whether or not this develops into something much more, I guess, material in terms of percentage pullbacks or retracements. And if this is just simply a buy the dip opportunity long-term for the continuation, the macro and intermediate continuation of this trend higher. So it's too early to tell. And when it's too early to tell, and when the market is somewhat bifurcated or at least somewhat confused, it's best, again, to let the market reveal itself and wait for the right opportunity to jump in when the technical picture suggests, of course, for you to do so. So on that note, everybody, thanks a lot for watching this analysis video. Enjoy your Tuesday evening. I'll be back with you to update you on the advancements of this market in due course, when, of course, it is important for you to understand what is going on and the nature of the market. So On behalf of myself and Pivot Point Trading, I'll see you next time. Goodbye.